I've been able to actually talk to a lot of your investors that are here. What are they telling you, and what are you telling them about the way that you now are managing TCW?
Yeah, so just for everybody's background, because not everybody may be familiar, TCW manages about $215 billion in assets. It is a very rich investment heritage, and we really are focused on credit, both public and private. We run another very liquid fixed income business. We actually run one of the largest mutual funds in America, team managed total return bond fund, hedge funds, and equities. So a lot of lenses through which to view the current crisis. And you ask what clients are asking us. The big question is whether or not we're going to have a hard landing and a very damaging recession. That seems to be on the mind of everybody, and also how we plan to navigate that. And I would tell you that we are in the camp that we will have a medium to hard landing here.
So you are already diverging from some of the views you've been hearing all day, that we're going to have a medium landing or a soft landing or a landing that we get out of quickly.
Yeah.
Why is your view so different? Why do you see a harder landing?
You know, I will say, as a new CEO, I really want to wrap myself in the warm blanket of a soft landing. It reminds me of our old friends that inflation is transitory, but I just don't think that's what the setup is here. There's three main reasons for that. The first reason is that, in my experience in investing, the longer the recovery, the worse the correction. And we've really had a very robust 15-year recovery here with a small blip, a lot of excess to work out of the system. That's why we saw money supply print last week at its biggest correction since the Great Depression. The second reason is that small businesses rely on small banks, and that's a big problem, a very, very big problem. Half of Americans are employed by small businesses. As you probably know, contributes half to GDP. And if you look at companies with 100 employees or less, 70% of their commercial industrial financing is dependent on banks with less than $250 billion in deposits. And 30% is dependent on banks with less than $10 billion in deposits. So as we get this deposit flight, we're going to have a credit crunch, and that's going to put downward pressure on jobs. And then the third thing is just that when capital reprices this aggressively, something's going to break. And we've seen a few things break already with the banks, which we've just mentioned, but there's going to be more things to break along the way. That's the bad news. The good news is that TCW is a value-oriented manager that really leans into dislocations, and so for our clients, this should be a very rich environment for our investing style and approach.
Well, let's talk a little more about the banking part of the equation, just because we're seeing such a historic deal here with First Republic's failure and then sale. That is one last major bank in America. What does that mean for credit contraction on the heels of credit already contracting?
Yeah, so there will clearly we are going to have a recession. We know that because the world moves in cycles. They're often precipitated by credit contracting. We're obviously in the midst of that. We expect to get worse. I think the question we got to consider is, where is the next dislocation going to come from? And there's two areas that we're really focused on. One is commercial real estate, and the second is in the private credit markets. In real estate broadly, we're underweight across all TCW. We are comfortable with residential. We actually think that that can perform through this correction because we've got a lot of excess savings on the consumer. Most of those loans are fixed rate, which means that actually people are highly incentivized to stay in their homes. These are all reasons that residential looks okay. But commercial is very challenged. And the headline I'd give you there is that about $3 trillion of commercial loans are going to come up for negotiation in the next 24 months at a rate level that's 4 points higher. So there is going to be a lot of pain in that part of the market. Some of it's priced in. We've obviously seen that in the office REITs. But if you look at CMBS, commercial mortgage-backed securities, there's a lot of illiquid tranches. And they're not going to reprice until the equity holder turns in the keys. So there's going to be a very long tail of opportunities there that we believe we can take advantage of for our clients in the securitized space and also through direct lending.
That's pretty interesting, because that means at some point you'll be willing to take on real risk in these markets that might become quite distressed.
I agree, and that's absolutely true, and dry powder is key here. I think that our investors should think about that at their portfolio level, for sure, individual and institutions, and it's something we're very focused on at TCW because we prove ourselves through these dislocations in the market. As I said, we expect things to deteriorate, and we are poised to perform for our clients.
Now, I want to talk about not just the U.S. banking failures here. You had 3 banks in the United States, but then you had one big hiccup internationally. With Credit Suisse. You guys were a debtor to Credit Suisse.
Correct.
How did that trade play out, and what did it tell you about how you want to be involved in bank debt?
Yes, so to take a step back here, I think it's a great illustration of how TCW is a value-oriented manager that leans into these dislocations. We have a phenomenal credit team run by Steve Purdy and Jerry Kudzel, and in 2022, when the rest of this market was running away from Credit Suisse, we went into Switzerland, spent time with the C-suite there, and really determined that Credit Suisse had this very valuable asset, obviously the wealth manager, the Swiss bank. They did all the forensic analysis, determined the balance sheet was in pretty good health, and really came to the conclusion that a lot of institutions, including UBS, would be willing to step into this asset if things went sideways. They determined to own the holdco bonds of Credit Suisse, that was senior enough in the capital structure and had enough asset coverage, and they leaned into that position on behalf of our clients. I give this team a lot of credit. In the week leading up to the eventual merger, they put another $500 million of our clients' capital to work in that position, and obviously it's worked out very well. And it's a great illustration of how we lean into these dislocations.
Yeah, talk to me more about dislocations here, because that is some pretty nimble movement. Yeah. And I think, and risky, frankly. And so, you think about credit and you think about the safety in credit relative to equities, but this is not for the faint of heart.
Right.
So how are you leaning in to potentially risky activities now?
Yeah, so that's a good example of what we did in the public markets, and the answer to how you manage the risk is you have a very deep, experienced team that can do the due diligence and do the work, put the work in to get to the right answer on those positions. I think the other area we're focused on is in the private credit space, and I think people need to be prepared for some accidents ahead in private credit. I want to be clear that I think it also may be one of the great investment opportunities over the next decade if you approach it in the right conservative way, but we are going to see some major accidents ahead in private credit, in our view. The main reason for that is that 96% of private credit firms were actually started post-global financial crisis in an environment of low to zero rates. That's a very easy backdrop to operate against. You said at the outset of this interview, I've only been here 10 weeks. I can tell you an actual warm blanket that I am wrapping myself in is that our private credit team, led by the incredible Rick Miller, has been at this since the early 2000s. We're one of the very few managers that have been through 3 recessions in the private credit space. And I would say to everybody watching this, what you want to ask your managers, what you really want to focus on, are you in a covenant-heavy portfolio? Because when things go sideways, covenants give you the ability to be at the table, very important. Has there been a lot of diligence on the asset? We've had 5 years where diligent light became a term. That's not going to be fun over the next 5 years if you arrived at it from that perspective. And then just a third observation I want to give you that I don't think a lot of people are focused on is that you and I remember that last year people were surprised that credit and equity went down together. We haven't yet in the public markets. We haven't yet experienced that in the private markets, but I want to suggest to people that we may see some correlation between private equity and private credit, because so much of this market in private credit has been taking the credit of big scaled private equity sponsors. And there is going to be correlation to those assets. So you also want to make sure your manager is good at origination and that they're not just dependent on these large private equity sponsors for putting the portfolio together.
How much pressure is there from a public credit manager to push into the private markets, given the scale of the fundraising that's in the environment right now?
I would say we don't feel pressure from our clients to do it because there's always going to be a demand for liquid credit. The reality is 30% of the credit asset class now is in the private space. And I would kind of look at it this way, big picture. What are investors trying to do broadly? They need to own a piece of global GDP across the capital structure. And the productive capacity of this country in particular is migrating more and more to private markets. And so if you just want to make a portfolio that's going to be reflective of great opportunities, you need to invest from the public across the private divide. And we are certainly going to be doing more of that at TCW.
I'm really going to ask you to double down on that private market critique here, because you might be the only person on this set that will do so. There's so much excitement around private credit, but to the extent you see cracks, where do those cracks start to form and when do they start to show up?
They will be showing up, in our view, kind of in the next 12 to 18 months as we have to absorb those higher rates and probably excess investment in some parts of private equity start to become more realized. I think there could be cracks. And again, I just want to be clear, this is an asset class where perhaps manager selection hasn't mattered a lot over the last 15 years, because we all get to be geniuses when capital's free. And I'm just making the point that us, and I know there are other managers out there that have been very, very conservative, that really do care about the covenants, that are doing a lot of diligence, that are doing our own origination. We're going to really have an opportunity to differentiate ourselves as this environment deteriorates.
Now, for the credit side, even the public market side, you still have this massive rush to money market funds.
Yes.
You have people parking in cash.
Yes.
Because why take on credit risk?
Yes.
Why take on credit risk?
There's still a need. I mean, if you, in a money market space and you look at inflation, your real return is still very small. Investors need to compound much higher on a real return basis into the high single digits. And so they're going to come, I believe, continue to come to the credit markets for that, public and private. And then after things recover, equity will obviously always get bid back.
On the credit side as well, you know, you saw it with the regional banks. Something that was safe one day is not the next day. How quickly we saw the speed of downgrades.
Yeah.
Do you worry about that in the credit portfolios, given that view of the hard landing you see ahead?
I'm glad you brought that up, because yes, I think credit can perform in this environment, but we're extremely conservatively positioned in our credit portfolio broadly and really across TCW in the more defensive sectors. And from a bank's perspective, actually the globally systemic important banks are a good place to be invested for the reasons we kind of already discussed. But regional banks is an area we are concerned about because of the deposit flight, and also they have the highest exposure to commercial real estate, which we also already explained is an area we're concerned about. So yes, that's reflected in our positioning.
So to that note, will you not touch regional bank bonds, and are there other things that you just are not willing to touch in a market like this?
We would be very underweight the regional banks, and I would say that's true on the credit side. It's also true in how we're broadly positioned in the equity portfolio. And of course, there's going to be a lot of areas of the market that won't perform through a recession, and we will either be underweight those areas of the market versus the index, or in where we can, we'll be short them.
10 weeks on the job.
Yeah.
What can people expect for you for the next year and a half?
I am so excited to be at TCW, and I got to tell you, one of the most energizing things about leading TCW is the caliber of investment talent. It's outstanding. We're having a lot of fun working together, and I really want to do the following thing, and this is the advice I got from a CEO that's leading an incredible LA-based institution, which is Bob Iger, which is that we have to respect the heritage of these great institutions while evolving for the future. So that's what you can expect to see from TCW. We're going to respect our incredible investment heritage over 50 years, but we are going to evolve for the future. And that means that we're going to do things like internationalize the business, both in getting more investors around the world, as in our risk takers, but also internationalizing our client base, using more technology and quantitative tools in the management of the portfolios and the delivery of those portfolios to clients. And then the third thing we've already talked about, which is really pushing into more alternative asset classes and extending our leadership position in leveraged finance.
You left the door wide open for AI and ChatGPT.
Yeah, we're already talking a lot about that, actually. So we're going to be very committed to being on the leading edge of technology for our clients, which is going to require a large investment, but the team's really committed to doing that.